Netflix stock soared yesterday after its latest earnings for Q4 2023. Where 2 years ago the stock dropped from almost $700 to $170, a 75% decline, the stock has been climbing since halfway 2022. Was it the emotion of investors, or has something changed in the last few years? Let's analyze and value Netflix stock. Looking at the stock overview, we see a current stock price of $544. Yesterday, the stock went up by 10.7% or $52 per share. Netflix now has a market cap of $238 billion, with a revenue of almost $34 billion in the last 4 quarters. With a net income of $5.4 billion, or about $12 per share, the current PE ratio is 48. In the last 52 weeks, the stock price has doubled from a low of $285 to $562. But we can also see that compared to 1 year ago, the stock is 35% higher. That means the stock price was volatile. Zooming out to the last 5 years, we see an increase of 50%, and the decline of 2021 and 2022 is clearly visible. In the 3 charts, we see revenue grow with almost 11% on average for the last 5 years. Net income grew by almost 24% per year in that time, and the cash flow went from negative to almost $7 billion in 2023. When we take a look at the scorecard for Netflix, we see a score of 71 out of 100. Netflix does not score based on valuation, where all ratios are higher than we like to see. For growth, management, and profitability, it scores all points. It does not pay a dividend, and for this type of company, that is okay. It scores 10 out of 15 points for the analyst part, where we see a price target that is 30% lower than the current stock price. But given the recent earnings, this might be based on older analyst reports and may not reflect an actual price target. We will take a look at this part later in the video. First, we take a look at the charts to see a lot of financial data in a visual way. Most of the charts have been updated with the 2023 data, but not all. We see revenue growing, but it is a slower growth than we saw years ago. EBITDA took a hit in 2023, but net income looks good. Like mentioned before, the free cash flow has seen massive growth in 2023. Earnings per share reached its highest point this far because of growing profits and declining shares outstanding. The other charts are not yet updated for the 2023 data, so let's take a look at the financials for the margins of Netflix. We see revenue growth of 6.7% last year, as well as 2022. That is much lower than we saw in the years before. But scrolling down to the bottom of the page, we see the different margins for each year. For 2023, we see a gross margin of 41.5% and a net income margin of 16%. This is similar to 2021, the year that Netflix reached its all-time high. Here we also see a dip in margins in 2022, and so it makes sense that the stock price went down. But 75% decline might be an overreaction and shows that emotion took over for many investors. Analysts have an average price target of $378 according to our data. But as mentioned before, this might not be up to date yet because of the recent earnings. So let's hop over to Seeking Alpha as another data source. Here we see analysts expect the earnings per share to grow with double digits for the next 10 years. For 2027, where there are still 10 analysts available, we see an EPS estimate of almost $29 per share. For revenue, we also see double-digit growth for the next few years, and expected revenue of $51 billion in 2027. Looking at Wall Street's price targets according to Seeking Alpha, the average is at $550, or just 1% upside. The low is at $335, while the highest price target is at $700. 23 analysts have a strong buy rating, while the quant of Seeking Alpha has a hold rating. Soon we will launch our website so you can analyze and value stocks, mark them as favorites, or add them to your watch list. Subscribe to our channel so we can keep you updated on our launch. Now that we have all this data, let's try to value the stock. At this moment, we have 3 tools to help us. First, we start with a multiples valuation. We make 3 scenarios for the next 5 years to see if the current stock price is interesting based on our expectations. We expect revenue to grow with 8, 10, and 12% per year for the next 5 years. We see margins improve in the future, so we go with 15, 17, and 19% profit margin. For shares outstanding, we expect between 0.25 and minus 0.25% per year. The PE ratio is difficult but important. We currently see a ratio of over 40, while in the last year this was 36. Given the high multiple in the past, we should base it on future revenue growth and profit margins. That is why we go with 20, 24, and 28 as P/E ratio. This is the multiple we expect the market to pay for the earnings per share in 5 years. For a margin of safety, we use a required return of 10, 11, and 12% per year. If we click the Make Calculation button, we see 3 prices appear. All prices are in red, meaning what we want to pay is lower than the current stock price. In our base case, we want to pay $300 per share at this moment, while for the bull case, we want to pay $415. If we click at Show Calculations, we can see how these prices are calculated. Looking at the bull case, we see revenue grow to $59 billion in 5 years and earnings per share to $26. This is lower than analysts and might explain why our price to pay is lower at this moment. We expect a share price of $730 in 5 years, giving us an annual return of 6% if we buy it at the current stock price. Next, we take a look at the discounted cash flow. We see a very volatile change on a yearly basis. 2020 was the first year they had a positive free cash flow, and that means our averages are all 100% growth because we compare to years that were negative. So we assume 15% growth per year for the next 5 years, 3% perpetual growth, and a discount rate of 8%. If we calculate, we see a red box with a price of $517. This is lower than the current price, but relatively close. Last, we take a look at the Lynch valuation. This chart is based on Peter Lynch. He plotted the stock price on one axis and the earnings per share on the other and said that both lines should be close to each other. When earnings per share grow, so should the stock price. We see the stock price from 2014 to 2022 was always way higher than the blue earnings per share line. But then we see the major decline in share price when earnings just dropped slightly. We see investors acted emotional on this decline in earnings. The stock price dipped deep into the blue, and this might indicate undervaluation. Now, almost 2 years later, we can say that it was definitely undervalued at that time. And at this point, when both the stock price and the earning per share line are close to each other, we might think of it as fairly valued or slightly undervalued based on the lines before 2022. But that is our analysis and valuation for Netflix stock. Let us know what you think of Netflix stock or what stock you want to see in a future video. Also, make sure to subscribe to our channel so you never miss a video in the future. Thanks for watching, and we hope to see you in the next video.